You know, we're going to talk about something that's probably costing you more than your car, more than your vacations, maybe even more than your house all combined. And the craziest part? It's probably listed on your investment statements as a number so small you've never even given it a second thought. Today, we're pulling back the curtain on the hidden cost of those tiny little fees. So let me just ask you straight up. When you see a 1% fee, what do you think? A penny on the dollar, right? Kind of feels like a rounding error. But what if that single percentage point is quietly one of the most important, most impactful numbers in your entire financial life? And that right there, that's the big idea we're going to unpack. This one sentence changes everything about how you should be looking at your investments. See, it's not just a fee, it's this silent drain on your future wealth. Understanding it is the absolute key to protecting your retirement. All right, so let's get into the why. Why do we all fall for this? Well, it turns out our brains are basically hardwired to see that 1% and just dismiss it. It's a psychological blind spot, and man, is it an incredibly expensive one. I mean, it's an easy conclusion to draw, isn't it? You think, well, hey, someone's got to manage this stuff, try to pick the winners, and 1%, that seems like a totally fair price for their expertise. It feels small, it feels reasonable, like a good deal for not having to worry about it. But that feeling, that's exactly what the system is designed to make you feel. So now it's time to pull back the curtain and see the real math. And I want to be clear, this isn't about market risk or a bad year for stocks. This is about a structural drag on your account that is working against you day in and day out, year after year. We're going to look at two completely different futures. On the left, you've got the path of a typical investor, paying about 1.5% in fees, pretty standard stuff. And on the right, you've got the path of an informed investor, someone who's paying just 0.1%. As you're about to see, the difference between these two paths is, well, it's absolutely life-changing. Okay, just take a look at this. Let's say you invest just $500 a month over your career. With those low fees, like you see in that first bar, you could end up with a very nice $1.2 million. But with that average 1.5% fee, look at that second bar. Your final balance is just $790,000. That is a massive, massive difference. Let that number just sink in for a second. $410,000. That's the difference. We're not talking about a rounding error anymore, are we? That's a house. That's retiring a decade earlier. That is a life-changing amount of money to lose, all because of a small fee. And this right here is the crucial point. This money didn't just disappear into thin air. It wasn't lost because the market had a bad run. No, it was systematically transferred from your pocket to the fund managers and the financial companies, all thanks to the dark magic of compounding fees. So how does this trap work so well? Why is it so effective? Well, it's not just about the numbers. It's about psychology. There are these specific cognitive biases that make pretty much all of us vulnerable to this. Okay, the first one is something called ratio bias. Your brain sees 1% of your, say, $30,000 balance right now and thinks, okay, $300, I can live with that. What it doesn't do, what it can't do, is instinctively calculate 1% of the $1.2 million your account could become someday, because that's $12,000 a year, every single year. Our brains just aren't built for that kind of long-term exponential thinking. And the industry uses this bias against us through a practice called shrouding. By quoting fees as a tiny little percentage instead of a big, scary dollar amount, they make it incredibly difficult to see the true cost. It's a deliberate design choice, and it perfectly exploits our cognitive blind spots. And here is the ultimate irony, the real kicker. The entire financial world is built on selling you the magic of compound interest, the eighth wonder of the world. But then they turn around and use that exact same powerful force against you, compounding those tiny fees into a fortune that you never, ever get to see. Okay, so that's the bad news. But here's the really good news. This is one of the easiest financial problems you will ever have to solve. Seriously, it takes just a few minutes, and it can literally change your future. Let's walk through the plan. This is it, your 15-minute action plan. It is 3 simple steps. First, you're going to get your hands on the fee disclosure for your retirement plan. You can just ask for it. Second, you're going to find a line item called the expense ratio. That's the official term for the annual fee for every single fund you own. And third, if those ratios are high, you're going to move your money into low-cost alternatives. That's it. And here's what you're looking for. The goal is to get those expense ratios as low as humanly possible, ideally under 0.10%. Big providers like Vanguard, Fidelity, and Schwab, they're famous for offering these super cheap index funds. And all an index fund does is own a tiny piece of the entire market, instead of trying to pick winning stocks, which is exactly why they are so incredibly cheap to run. So here's the bottom line. Spending 15 minutes to do this might be the most profitable quarter hour of your entire life. I'm not kidding. There is no stock you can pick, no market timing trick, nothing that will guarantee you a higher return than the money you save by simply cutting your fees. So, I'll just leave you with this one question. That $410,000 from our example, what would you do with it? Would you travel the world? Would you retire a decade earlier? Leave a huge legacy for your family? This isn't some hypothetical money. It's your money. And now you know exactly how to go and get it back.